Welcome back to the Deep Dive. We're jumping straight in today with a company that, well, gave us a classic head fake this quarter. You know, a clean earnings beat, looked good on paper, but the market, it just punished it immediately. So today, we're doing a comprehensive breakdown of their Q3 2025 earnings call.
That's absolutely right. And our job really is to cut through all that confusing noise, get past those initial headlines.
Exactly.
We need to figure out what the strong EPS, that little revenue miss, the new guidance, and importantly, the strategy talk actually mean for where this company is headed, especially, you know, in this pretty dynamic market.
Okay, let's lay out those headline figures because that's where the contradiction really starts, isn't it? Yeah. Adjusted earnings per share, EPS, came in strong at $1.18.
Yep.
That beat the consensus expectation, which was $1.14 by 4 cents. So a clear win on the bottom line, you'd think.
A textbook beat, absolutely.
Yeah.
But here's the big but, right? And it's exactly why the market reacted so negatively. We saw shares drop significantly in pre-market. What was it? Between 2.7 and 4.1% initially?
Yeah, something like that.
The problem was revenue. That landed at $699 million, just a tiny bit short of the $700 million expected. Okay, small miss, but the real concern, I think, was the organic growth, just plus 1% year over year.
Right. So investors just looked straight past that 4-cent EPS beat and zeroed in on that softness on the top line. And I guess the cautious commentary they gave about 2026.
Totally. And that high volume we saw on the closing day almost tripled the 50-day average, right?
Yeah, huge volume.
That just shows how convinced the market was that the demand weakness, that 1% growth, was the more important part of the story here.
It signals a fundamental rethink, maybe.
I think so. When you miss revenue, even just a little bit, but you beat on EPS, investors start asking questions. Is this margin discipline happening because demand is strong, or is it happening to mask weak demand?
Good point.
And right now, in the life sciences tools sector, that fear of weak demand, it scares people way more than strong margins reassure them.
Okay, let's dig into that performance mix there, the different segments, because the growth story really is split, isn't it?
Very much so.
If you look at diagnostics, that brought in $356 million in revenue. It grew 2% organically. And the real bright spot there seemed to be reproductive health, specifically newborn screening. That showed, high single-digit growth.
Yeah, solid growth there. But the weakness, the vulnerability, really showed up in the life sciences segment. That was $343 million.
And that was flat organically year over year.
Flat, yeah. And if you look inside that segment, you see the split again. Sales to pharma and biotech customers, they were actually up low single digits, a bit positive.
Okay.
But, and this is key, sales to academic and government customers, they actually declined low single digits in the quarter.
Okay. So that suggests maybe those post-pandemic funding boosts, the government stimulus tailwinds, they're pretty much gone now for that part of the market.
It looks that way. It seems to be over.
So given that flatness on the life sciences side, the silver lining, and certainly what management kept highlighting, was their execution on margins and cash flow.
Definitely.
Adjusted operating margin hit 26.1%. That was a bit above what people expected. It shows they're really disciplined on costs, even when revenue isn't booming.
And this is where that financial discipline really makes a difference. You know, it provides a solid foundation. Free cash flow, FCF, was strong, but $120 million in Q3.
Which is a good number.
It is, but what's maybe even more impressive is the conversion rate. That's like 88% to 90% conversion from adjusted net income.
Wow.
Yeah, for a business selling complex instruments, needing capital, keeping FCF conversion near 90%, that's fantastic execution, way above their long-term target.
And that strong cash flow feeds directly into how they deploy capital, right?
Yeah.
Spent $205 million buying back shares just in Q3.
A hefty chunk.
And then the big news, announcing a new 2-year, $1 billion buyback authorization. That's a huge commitment.
It is a massive number. But let's play devil's advocate for a second. Is that billion-dollar buyback really just pure confidence? Or is it maybe a bit of classic management financial engineering? You know, to hit that high single-digit EPS growth they're guiding to for 2026, which they might struggle to get organically right now.
That's a fair question, because they did say that high single-digit EPS growth for 2026 is before you factor in the impact of this massive new buyback.
Exactly. So they're kind of using that financial discipline, that engineering, to create value while they basically wait for the end markets to properly recover. Smart, maybe, but important context.
Okay, so if the core segments are sort of flat or under pressure, where's the actual growth coming from on the top line? That takes us straight to the clear standout, Signal Software.
Right, the star of the portfolio. This high-margin recurring revenue business grew around 20% organically in the quarter.
20% is huge compared to the overall 1%.
It really is. And let's pause on that 20% growth for a second. It tells you they've successfully made that shift, right? From just selling boxes, hardware, to selling the connectivity, the insights. That's where the really high margins are.
Yeah.
And this software engine acts as a great counterbalance to the ups and downs of the instrument sales cycle, which can be super volatile. The metrics are just superb. Annual recurring revenue, ARR, is now over 40%.
Okay. Wow.
And their net retention rate, over 110%.
So existing customers are spending more.
Exactly. They're not just getting new customers fast. The ones they have are embedding the software deeper, spending more each year. That's the sweet spot.
And they're still innovating on the diagnostic side, too, for future growth. You mentioned the NeoLSD 7-plex kit momentum, got IVDR approval in Europe.
Yep, and they're expecting FDA clearance for that expanded newborn screening kit in early 2026. That should definitely boost that already strong, high-margin reproductive health business.
Okay, so innovation's happening, but what about the big risks? It seems like the most immediate, maybe painful one is geographic, right? China.
Absolutely. China is the key headwind right now. Overall, Asia was down mid-single digits, but China specifically, down sharply in the low teens.
And within China, the diagnostics business got hit particularly hard, down over 20% organically.
Yeah, and Management was pretty clear on the cause, the expected impact of DRG-related volume declines. It's heavily concentrated in their immunodiagnostics business over there.
Okay, DRG. Remind us quickly what that means for the listener.
So for DRG stands for Diagnosis-Related Group. It's basically a policy thing in China. They're standardizing payments, consolidating how things are bought.
Right.
And it really targets the pricing power of high-volume kind of standard products like immunodiagnostics assays. It forces pretty immediate price cuts and puts pressure on volumes.
And management expects that specific DRG issue to stick around for a while.
Yeah, they said it'll likely persist until they lap the anniversary, which would be Q2 2026. So still a few quarters of pain there.
But interesting counterpoint. They did say the immunodiagnostics business outside of China grew high single digits.
Which is important. Yeah. It suggests the underlying demand away from that specific policy risk in China is actually quite healthy. The core business isn't broken.
Okay, let's talk about the forward guidance then, because this seems to be what really cemented the market's skepticism.
This is where the cautious tone came in.
They reaffirmed the full year 2025 organic growth range, 2% to 4%. That was fine. But it was the language around next year, 2026, that caught the attention.
Right. The preliminary outlook for 2026 was set in, and they used the word a prudent 2% to 3% organic growth range.
Prudent. Okay.
They did note this translates to high single-digit EPS growth before more buybacks like we discussed. But that 2% to 3% top-line guide is, well, it's pretty low.
So the question is this management just setting a really low bar so they can easily beat it later, sandbagging? Or is this genuine concern about those academic and government markets just not bouncing back quickly?
I think it's probably a bit of both.
Yeah.
But it's definitely them admitting, maybe quietly, that they don't see a big, broad, immediate recovery in overall tools demand coming just yet.
But they did offer a sliver of hope.
A small one. They flagged improving industry clarity looking into 2026. And they said they saw some early signs of increasing activity in September and October. But, and this is important, specifically on the instrument side with pharma and biotech customers.
Not academia or government.
Exactly. They were careful to say they're not seeing that pickup yet in the academic and government space. Still weak there.
So with the top line challenges, where are they focusing strategically? It seems like AI development is a big part of the answer.
Yeah, they spent a good amount of time on the call detailing their AI strategy. It's kind of two-pronged.
Okay.
Internally, they're already using custom AI agents, and they claim this is leading to real results, like sales reps seeing a 3 to 4 times improvement in converting leads.
Wow, that's significant.
It is. And they also mentioned seeing a 5% to 10% reduction in software development timelines because of AI tools. These are like tangible efficiency gains hitting the bottom line now.
So using AI defensively almost to boost efficiency while the market's tough?
Right. And then externally, they're launching commercial products with AI built in, like the Living Image Synergy AI software. The idea is it drastically cuts down the time scientists spend manually reviewing images from hours to minutes, they claim.
So they see AI as part of how they operate now, not just some future dream.
Seems that way. And we shouldn't forget the partnerships they mentioned, too. They highlighted the sequencing collaboration with Genomics England.
Right, and they shared that story about baby Freddie.
Yeah, that powerful anecdote, identifying his rare genetic condition really early through screening. It kind of grounds all this financial talk, doesn't it? Reminds you what the tech actually does.
It does, good context. And they also announced a new collaboration with Sanofi, developing an assay for early screening of type 1 diabetes.
So still pushing forward on innovation and partnerships.
Okay, let's quickly put the stock's recent performance in context. It hasn't been great, has it?
No, definitely lagging. Down about, 15.8% over the last year?
Yeah. And that compares pretty unfavorably with the broader healthcare sector ETFs like XLV, which have been more like flat to slightly up over that time. Right. The underperformance probably reflects their higher exposure to those cyclical instrument sales and the specific pain points we talked about in China Diagnostics compared to some competitors maybe. But underperformance means it's cheaper, potentially, which leads us to catalysts. What could actually drive the share price up from here?
Okay, I see 4 clear potential catalysts. First, just the continued compounding of that high-margin signal software business. If that keeps growing at 20%.
That's a big engine.
Huge. Second, the execution of that new $1 billion share buyback. That's real support. Third, any positive regulatory news, especially FDA clearance, and then scaling up that NeoLSD 7-plex kit we mentioned.
Okay.
And finally, the fourth one is simply upside to that prudent 2026 guidance. If broader tools demand does recover faster than they're currently forecasting, especially in biopharma or academia, that guide could look very conservative very quickly.
Makes sense. All right, that brings us to our segment, not financial advice. And remember, folks, this is purely for entertainment, drawing on the story we've just discussed.
Okay, so my thesis here is pretty straightforward. The market right now seems totally obsessed with that tiny revenue miss and the slow instrument recovery, which is why management gave that cautious 2% to 3% guide.
Right, focusing on the negatives.
Exactly. And I think they're fundamentally undervaluing 2 things that are creating a ton of value under the surface. First, the incredible financial discipline, those 26% plus margins, the nearly 90% FCF conversion. And second, that compounding growth engine in the Signal software.
So the market's missing the internal strengths.
I think so. They're focused on the macro headwinds.
Okay, so what's the outrageous but plausible trade idea based on that?
All right, here it is. You initiate a long position, but you do it using midterm call options, maybe 6 to 9 months out.
Options, okay. A bit more risk.
A bit more leverage, yeah. The bet is that the market's current gloom about the top line is temporary. It ignores those internal efficiency gains from AI, the software growth. The aggressive $1 billion buyback acts as this really strong financial floor, kind of a margin of safety.
Right.
So the combination of signals hitting 20% organic growth consistently, plus that huge capital return, I think it forces a significant upward re-rating of the stock when that 2026 guidance inevitably gets revised upwards from this prudent baseline, probably sometime in the first half of 2026.
So it's basically a bet on internal execution and financial engineering winning out over the current macro concerns.
Exactly. Betting that the company's own actions can override the sector's softness, at least in terms of share price performance over that time frame.
That's definitely a bold take. Betting cash flow and internal wins trump the cautious macro outlook.
Okay, so wrapping this up, what's the core takeaway for you, the listener? We saw an EPS beat, a big share buyback announced.
Good thing.
But they were completely overshadowed by that persistent, even if manageable, softness on the top line and some very cautious language about the year ahead.
Yeah, and the provocative question I'd leave you with is this. Management spent a lot of time talking about AI adoption internally, highlighting these massive efficiency gains,
Right.
like 3x to 4x better sales lead conversion. So the question is, how soon will those internal AI efficiency gains actually start to materially accelerate the overall organic growth rate? Could they push it meaningfully beyond that current, 2% to 3% prudent baseline and really start to validate the long-term story?
That's a great question. When does internal AI efficiency translate into visible top-line acceleration? Something for you to definitely think about as you dig into the materials yourself. Thanks for joining us for this deep dive.